What if I tell you that a rectangle and a line is all you need in trading to make money? Believe it or not, I make money every day using those two things with no indicators used at all, only price action. I'll show you in this video how I do it and what the rectangles and lines represent. I also want you to stay until the end of the video because I'll go over a simple two-step strategy that might change your life depending on only rectangles and lines. This is Mulham and let's begin. So to be honest, I tried almost all ways of trading for about 5 to 6 years of trading. So I almost, went over all those concepts and mastered them. Not only just, take a look at them, but I take some courses on them and I really mastered those concepts, but realized that for me, at least, they did not work. Now, that does not mean that they do not work in general. It was only my experience, and I'm just showing you what worked to me and what did not. So, I mastered support resistance. It did not work for me. Market structure. Elliott waves, actually, I spent hundreds of hours going over Elliott waves because I had some of my friends and they tried this way and they were making money. However, it did not work for me. Supply demand, same thing. I really mastered supply demand. It was not for me. Fibonacci, same thing. Candlestick patterns. This is where I started, the candlestick patterns as well as the supportive resistance. Some people are making money of them, not me. Y curve, price action, trading the price action. However, it also depends on some patterns in the chart. And then Gann theory, all those ways of trading, I tried them. They did not work for me. And I ended up using just another thing that is totally different. And this is the purpose of the video, is to show you that this is my way of trading. This is what did not work for me. However, if you're using one of those ways, okay, any of those 9 ways, and it's working for you, then I don't think you need to watch this video because you're already profitable. You can close this video and then go make money. Right? This is video for people who are curious about how I trade and also who had the same kind of story to me, which is trying all those things and they did not work. So maybe try my own way. So this is how I make money now. This is my trading strategy. I get questions all the time on Mulham, what do you do? What is your specific strategy? Because I posted a lot of other videos, but you realize at some point that they're all related to each other. It just that we change something and then the whole strategy becomes a different one. However, it's all about those two things, mainly those two things, and those 3 steps. Actually, it might look simple, okay, and it is very simple because we have 1 2 3 4 5 6 words only to explain kind of how I trade. However, simple does not mean easy. So it might look simple to you, but it's not easy. When I say easy, it means that it's something that can be achieved with no efforts and no experience. However, it's not easy. It might be actually much harder than what you do now, but with the experience, with the effort that you put, you could actually make it a little bit easier. But it is simple. When I say simple, I mean it can be easily understood. So this way, no need for indicators, even though there is no problem with indicators, but I do not use anything except maybe the session indicator. So the first step, and this is what I do, I wake up, and then almost at 1:30 a.m. EST, New York time, what I do is I open the chart, I draw some rectangles, and then I draw some lines, and then I look for reaction of those rectangles and lines, and I enter on a confirmation on the lower time frame. That's all I do for my day. Now, again, it's simple, but it's not easy. Sometimes I do struggle to execute a trade based on this framework. But you can spend some time, put some effort, and you're going to get in a level that you'll be satisfied about. Now, when we talk about rectangle, that represents a fair value gap. And if you're not familiar with fair value gap, then I think you have a long way to go. You're not going to be a master of those concepts from this video only. You have a lot of videos to watch and you have a lot of time to spend on those concepts. Now, fair value gap is that 3 candle pattern. We always look at this gap between the first candle and the third candle. And to be precise, the high of the first candle does not overlap with the low of the third candle, and that's going to equal to a bullish fair value gap. On the other hand, a bearish fair value gap. And again, it's a 3 candle pattern. So we need 1, 2, and then 3. 3 candles. We're going to be looking at the low of the first candle and then the high of the third candle. If they do not overlap, then that means we have the fair value gap, or we have the imbalance. Some people call it imbalance. Now, when we have this, that means this is now our fair value gap. Low of the first to the high of the third. This is the fair value gap. And this is what I mark almost every day when I trade. This is the thing that I trade based on the most, but actually equal to the other thing, which is lines. And we're going to cover what the line represent in the next slide. But if you need more information about fair value gaps, you have my channel. I do have a lot of premium free content on fair value gaps and how I trade them. But I'll also give you some examples at the end to understand how do I make money off fair value gaps. Now, when it comes to lines, we can see lines, or actually lines represent two things, and two different things actually. It can either be liquidity. So on the left side here, what we can see is that we're having this structure going lower, creating this range high and this range low. This is now a liquidity level. This is a liquidity level, as well as this one is, this one is, this one. Any higher low is a liquidity level, but not any higher low we can expect a reversal or at least a pullback from. That's the difference, and that is another lesson to go over. And I do have some videos. I think I'll put them in the description so you can actually differentiate between the highs where we actually expect a reversal from and a high where we expect maybe a break of structure from. Now, lines represent liquidity. So I'll be marking those levels of liquidity at the beginning of the day where I have some trend line liquidity, where I have relative equal highs, and where I have extreme lows of the range, all of those things. Now we can also use the lines to identify the structure. This is one of the use of the lines. We can actually look at our breakout structures and our market structure shift. If we consider this diagram here, what we can see is that whenever we close above a high that is with a trend, this is a breakout structure, a breakout structure, a breakout structure. It can help me identify what the bias is and what are the ranges that I'm interested in. So for example, as we close above this high here and we go up, this is now the range that we're interested in from this high to this low. And then price comes here. Now we go up again, we get another breakout structure here, come back to the range, we go up until we get a market structure shift. Then I'll be interested more on the lower side. This is what my bias will be, to the lower side, you see, respecting the new range to the lower side. So in short, the uses of lines, well, the first one is to identify the liquidity. The other one is to identify the structure, breakout structures and market structure shift. The ones with a trend and the ones against the trend, identifying a shift in the structure. Now the question comes, why? Why am I only focusing on the rectangles and lines? Because that's how the market operates, or at least that's how I see it, most of the time. We can actually see that price moves in two directions and two ways. The first one is from an internal liquidity, which is a fair value gap, and then moves to fair value gap to external liquidity, highs and lows. And the cycle goes on like this, so it never stops. Okay, so it goes from internal liquidity to external liquidity, external liquidity to internal liquidity, and that's how I trade based on how the market operates. So this way of trading, it will never stops working, and then it works, and it is a universal thing. So you could look at this in gold, in Nasdaq, and in the currency pairs. You'll see that it works in all of the assets. Sometimes it can be different. That's why I do videos about gold trading, sometimes about the euro dollar, because there are some specific characteristics that you can see in specific assets. But in general, you will see this working all the time. This is how the market operates. External liquidity, highs and lows. You'll see price taking a high, then retracing lower to a fair value gap. And then off that fair value gap, we can see price reacting higher to an external high. So let's imagine this as a fair value gap. As we come inside, then we push higher, taking a previous high. And then when we come to this high, we go lower to a previous fair value gap. That is how the market operates. It moves in those two different ways. But remember that this is not going to happen all the time. It won't be as easy as I'm showing you to identify. Why is that? I'm showing you the textbook. I'm showing you how it happens in a perfect scenario. However, it's not going to be a perfect scenario all the time. Now, sometimes it's not going to be all the time happening like this. What do I mean by that? What's going to happen is sometimes instead of going from internal to external or external to internal, sometimes when we have a lot of volatility and it's not the perfect time to trade, you're going to notice that what we do is we move from an internal to another internal, which is this example. You see, we go to this fair value gap here, and this is just a small pullback, so I'm not going to be considering this as our external. Okay, and even like, let's say we enter here, we go to another major internal. Now another scenario what's going to happen is we take this external and then we don't move to an internal. I mean, it was part of it. Maybe there was an internal here, but we go immediately without giving any respect to the internal. We go to the external, and that's what happened. We take the external here, we move to the other external immediately without showing any respect to the internal. And same thing here, showing no respect to the external high. So make sure to take a note of that. Now, how do I make money? Here is a two-step strategy to make money off the market using only lines and rectangles. So the first step is going to be on the higher time frame. That's going to be the framework and bias. What does a framework mean? It means that the reason why you're looking for a trade in the first place. So what is the reason, or what am I seeing here in order to take a trade? And I'll give you some examples on that. And then we're going to be moving to the lower time frame confirmation. That's it. It's going to be higher time frame to lower time frame. And then, framework and bias to finding a confirmation. That's all you need. Now, we're not going to be able to identify higher time frame and lower time frame. Some people would just tell you, oh, you're going to go to the lower time frame, but you don't know exactly what the definition of the lower time frame is. However, this is the time frame alignment you need to use. So when we're talking about higher time frame, it's going to be the one to the left, lower time frame, the one to the right. If we start from 1 hour on the higher time frame, finding the framework and bias, you're going to look at the 5 minute to find your confirmation. Same thing here, 15 minute, 1 minute, and then 4 hour, 15 minutes. So this is the valid time frame alignment you need to stick with. Sometimes it can be flexible, but this is my suggestion here, and this is the thing that I use. So here it is, one of the simplest strategies you'll ever see, but it's not easy. Remember the difference between easy and simple. That's why I keep reminding. So let's start with the framework. Again, the framework is a reason why you're entering in the trade in the first place. I mean, a lot of people talk about some, entry patterns, but they don't talk about the framework, because that entry pattern should be used as a lower time frame confirmation, lower time frame entry, but we need something in the higher time frame to give us a higher probability for that lower time frame entry to work. That's the logic of using the framework. So my best two frameworks, and you can have your own framework. However, my best two, we have the internal to external move. In other words, all I want to see is, I want to be able to identify a valid trend. So I want to see an uptrend, for example. I want to see breaker structures to the upside. I want to see bullish period arrays being respected to the upside. I want to see maybe, and this is what I'm going to be covering here, I want to see lows being taken and then rejecting off. So that's what I want to see in order to identify a bullish order flow. But in this case, I just want to see a breaker structure here, a previous one, and then maybe this low here being respected in another period array or sweeping another liquidity. So I want it to be a strong low, and then breaking structure. Coming back to the range, I just want to see a fair value gap here, which is an internal range liquidity, and then lower time frame confirmation here to go to the upside, at least to the high here, or maybe another internal. That's the first framework I want you to focus on, and those are the ones that I'm going to be focusing on also in the examples. The second one is the continuation liquidity sweep, or in other words, the fake market structure shift. Now, a lot of people, you will see people, taking or, identifying some market structure shift, but then the reality of it, and then what they realize after is that this is a fake one. Now, how do you identify a fake one? This is the way. We look for breaker structure. We look for a POI that is either an extreme or, just a POI that we know or we expect price to fill it, then you can see a creation of a low here. As we push higher, we get this fake market. So you see, we get this fake market session shift. Why? Because we took a high and then we take the low again into a POI. However, take a note of this breaker structure, which is the previous one. The structure here also needs to be bullish. This is going to be a fake market section shift. Price will take this low into a POI and then go higher. A lot of the time we can use the 61% rule. So if price does not come to the 61.8%, then that means most of the time it's an inducement and we can look for another sweep to the lower side before going higher. 1 and 2, those are the frameworks that I want you to focus on in order, at least if you are in a losing streak, to make your first winner. Now, when it comes to the confirmation, we have 3 types here. And again, feel free to, follow your own way. However, the 2 steps need to be there: framework and the confirmation. Confirmation, you can be flexible with that. 3 examples of a confirmation entry: market section shift, which we can see here, considering this as a higher time frame POI that is bullish. We can see that we have a low, we go higher, we take that low, and then we break above the last high, the last pullback with a displacement. This is a market section shift. We can look for a PD array here, any PD array, and that is one confirmation entry. Another one that can be actually the simplest among the ones that we have here is the fair value gap creation. So I just want to see a fair value gap being created here with the order flow. So aligned with the higher time frame POI. This is a bullish one. I'm not looking for bearish ones. I'm looking for the first bullish one, and that's one you can take. Another one is change in state of delivery. This one is when we get, consecutive bearish candles, and then we get to one big bullish candle that engulfs the previous one. And you can also consider, breaking above the consecutive bearish candles. I mean, it depends on how risky you want to go. This one is a change in state delivery, and then you can look for a continuation. If you're fan of this, I do have a video about order blocks, a full strategy for advanced traders using only order blocks. Just look up Mulham Trading Ultimate Order Block Strategy and you're going to see the ones that you'll be a fan of. I went on details, everything you might need about that strategy. So if you want more information about this, then you can watch that video. So those are the 3 confirmations. Again, feel free to use your own way of identifying the confirmation. Those are only examples, but they are valid. In order to ensure the understanding, I'm going to go over TradingView now, show you some examples, and if you have any questions, leave them in the comment. I'll try to get back to you. But if someone else also know the answer, then I know a lot of people would help you. Let's go to TradingView now. So a quick recap on what we want to see in the market: either a breakout structure to the upside and then retracing to the range into a fair value gap and going higher. Let me change this. That's one scenario, which is a breakout structure coming back to fair value gap, internal liquidity, then pushing higher. Another one can be, for example, a market section shift or a breakout structure, and then we want to see a fake market section shift. So something like this high now. A lot of people looking for this as a market section shift. Going to be a fake one, and why? Because we already get this market structure shift and then we're pushing lower. Okay, you see, we have a downtrend now. This is a high that we can look for continuation to the lower side from. This is what we're going to be looking for. Going to be given an example on a 4-hour, 15-minute, and then maybe 15-minute, 1 minute. So an example of what I want to show you here is, for example, this 4-hour market makers model. We can see that we are pushing higher here. We get this major breakout structure to the upside, and we have this whole range here. So we have this low here that broke the high, and then we retrace lower. Extreme fair value gap here that can push price higher. If we get a confirmation from here, then what we can target is the external high, and you see, taking that high very nicely and then continuing higher. We don't know exactly how far we can continue lower before the pullback, but this is going to be the first target here. Now, sometime you should keep an eye at the internal fair value gap here. If we disrespect it, then most likely we're hitting to the high here. So 15-minute confirmation here, and maybe sometime 5 minutes. You can enter from here. Another example is this one here. So this is the major structure. We can see that as we're going up here, we create bearish fair value gap also. Then we retrace higher back to the fair value gap. This is another market maker's model to the lower side. This is, I would say, against the main structure. Okay, you see, come into this fair value gap. Then we take the low of the market maker's model here. This time here, we also have one. We don't go to the external, but we keep going higher. And I'll show you why. I'll show you there is something that happened here that I know price is going higher. Another example, and we can see a lot of times we have the same. An example here is this. You see this breaker structure to the downside. This is the one here. And then we get this fair value gap. We keep pushing lower until we go back to the fair value gap. We go back to the fair value gap. We get few retest into that fair value gap until we take the low again. And it happens again. So this is a breaker structure to the downside. This is the strong high. We have a fair value gap here. You see, we go to the fair value gap and then we push lower. Now, this is an example of a lower time frame entry. We have different types of entries, and sometimes you're not going to get an entry, even though you have the framework. Sometimes it's not going to be, a clear entry and you can see it in hindsight. Sometimes you're going to enter it and then make money. So, different scenarios here. In this case, what we can see is that we get to that fair value gap on the 4-hour, which is right here. And we can see that we get kind of a nice reaction. This reaction actually, and this is a fair value gap that also broke structure. So this is a market structure shift. And then we have a fair value gap here. What we can do is enter on this fair value gap, either 50% or beginning of fair value gap, and then stop loss below the low. That is one example here. What I will target is maybe filling this big fair value gap here. And what you can see happening is price actually immediately touched that fair value gap and started going higher. This is on the 5 minutes. And then there's also the continuation after. Actually, there is no fair value gap here. And then we get this order block creation after 2 candles. So we have, if you're not familiar with order block, they're nothing but a pullback in the right structure. Okay, so this is a valid, bullish structure. Get a pullback here and then going higher, creating this as an order block. You can see we get a very nice touch to that order block, where you can actually also look for a continuation and then pushing higher. Again, same thing. So this is how you make money off 2 things. And you can see that. What are we using here? Are we using anything other than a line and a rectangle? Maybe some people would say a long position and a short position sometime. I mean, yeah, you're technically right, but to enter the trade, we're only using a line and a rectangle. So you can see we push higher from here, and the target can be sometime much higher than what you're expecting. Sometimes you catch the low of the day, the low of the week, and sometimes the low of the month. But we don't know where exactly to hold. That's why we're taking some partials here. And sometimes we can take the external. Okay, so this one is going to be a huge one, 11-1, if we get the right market makers model. Okay, so on the 4-hour, back to the 4-hour, you can see that after we enter here, we push higher. This is the target. You can see it takes some time, few days, and then we hit the target. Now you could do the same here. You could do the same here. Same thing here. Now on other assets, it's going to be the same. But I want to show you something also that we talked about. And this is the other framework that we're talking about. If you can see here, what happened is we got this market structure shift. We started going bullish, right? So this range here is very big, and it has a lot of displacement, that it actually broke this whole structure here since July to August. So a structure of a whole month is broken above. That is a very strong movement that can identify a shift in the structure. So market structure shift here. Now we are bullish. What you can see is, and we have different types of continuation liquidity sweep. One can be an inducement sweep. Another one can be a structural liquidity sweep. In this case, what we can see is as we're pushing higher, we get this fair value gap here, and there is another fair value gap here, and we have this low here. Now think about the bias and the structure. Are we bullish or bearish? If we are bullish, you could take lows that are major in the structure that has POIs below. In this case, you can take them to look for continuation. One example is this one. So you see this low here that has this fair value gap below. What happened is price sweeping that low into the POI and then pushing higher to where? To the external again. That is a very high probability trade, which is the continuation liquidity. Same thing here. If you can notice, we push lower, we get this fair value gap. This is now an inducement. Why? Because we have still unfilled part of the fair value gap. And then we are still bearish. This now is where a lot of people are actually looking for a market structure shift. This is a fake one. And you see, we take that low again, we push lower, could have made some money here. And then finally price actually does not take that one. So this would be a very nice winning trade for you. Maybe entering somewhere in here, stop loss above the high, right? And targeting the low. Actually, if you're entering your lower time frame, it's going to be somewhere in here maybe. So that's a valid one. Always remember that a lot of people would tell you that market structure goes like this. But the reality is going to be like this. Going up, coming lower, going up, sometimes taking the low here, going up, creating a low, taking that low, going higher, maybe then taking this low again, and then going up, taking the low, going up. You see, we sweep lows, maybe taking this low also. We sweep lows, we sweep lows, we sweep lows, and then we push higher instead of respecting all the lows. In a market structure that is pushing to the upside, we're going to be taking the lows as liquidity in order to push higher. Now, this is how that example of the liquidity sweep looks on the 50-minute. So for our level here, for our fair value gap, using only rectangles and lines, this is what we have. Now we can see we take the low, but then we keep going lower to go to the POI, to the fair value gap. We push higher, no fair value gap here, only like a small volume imbalance. I don't really rely on those on the FX market. You can see a creation of a fair value gap here. This one we could take entry here. Stop loss can be, in this case, I'm not gonna put it below the low all the way, maybe at the body of the low, and then targeting the external. That's an example, but definitely I'll take some partials at those highs on the way, but ultimately this is my target and playing the price action. So you see we get filled here, snapper entry, and then maybe go into the 1 hour time frame. See if we can make it faster here in the price action. Okay, we move higher, so it's consolidating for some time, and then what happened is a liquidity sweep before going higher, and that is another continuation purge. Same thing. I mean, if you consider this market structure here, what we can see is we push higher, we create a low. I mean, let me use the other one. So we push higher here after sweeping a level on the 4 hour. The structure here, we become bullish here because we swept a 4 hour low with the 4 hour structure, which is the major bias, okay, or the major structure. We push higher here, we create a low, we take that low before pushing higher. So we take the low, then we push higher. What happened here is we create this low also, and then we sweep it before pushing higher. We create this low here, we sweep it, we push higher. And then where's the last low here? So there is this one here, there is this one, but it was taken by this one. I could also say this one. If you could find a lower time frame confirmation here, you could take also this one as a continuation to go to this high. I know sometimes it can be tricky, but it's going to be much easier when you practice. And sometimes experience will tell you when to look for. So you see here, we are pushing lower. We create this high, go lower. Continuation purge would be taking this high. It fails here, but then again, taking the high again and then go lower. So you see, this is the sweep here, going lower. This is gold on the 1 hour time frame. If you look at the structure here, we can see clearly that we are bullish. I want you to notice what is happening in this price action leg here. What is happening is very, very nice textbook example. What is happening is this fair value gap being filled, pushing to the external, break a structure to the upside, filling the internal range liquidity, going higher. But I want you to also notice what is happening here. At this fair value gap, what is happening is filling that fair value gap the first time, then taking the low again as a continuation purge, breaking structure to the upside. So that is your first opportunity to enter here. I mean, you could have entered from this one, could have gone up, then this is the next one. We take the high now. Where is the low that took the high here? This is the low responsible. That means we could look for also another continuation purge, taking this high again after taking this low. This is the continuation purge here to push higher. Now, what do you notice after is you see this high here? We break structure to the upside. Where's the low that was responsible for taking this high? It's actually this low here. What happened after, if you can notice, is we have this POI, which is the wick here as a POI. I already explained this on my gold secrets. You can see that we take that low again into the POI as a continuation purge, pushing higher. And you can see also here, what happened is we also take, we break structure here, fair value gap here, and then we have a low that did not go to the fair value gap. What do we notice here? Continuation purge to the upside, taking the high. It happens over and over. On the 15-minute, you can see it happening more. This is how you make money. I could have gone to the lower time frame and show you examples on those, but it's going to take more time. You could go by yourself to this date here. This is on New York time zone. You could go here and see what happened on the lower time frame. But you will see that a lot of the time you'll get a very nice entry confirmation on the lower time frame.